Hello, it's April 8th, and I'm giving you an update for the foreign markets, and then we'll try to include a global index for the stock market. I'm Rich Possum for Critical Point. Okay, I don't know how valuable this will be, so if that turns you off, it's okay not to watch this one. I don't know as anything has really changed from our long-term point of view in the global markets. Last week, we got some great PMI data for the world and regions of the world, suggesting the world is probably out of recession moving forward. But Europe still has complications and problems. And then down in Brazil, they have their virus and political issues. Things are not going well for them. But in general, I think the world's going to do better. But anyways, let's dive in. This is the South Korean Kospi stock index. It put in a long-term bottom, 3-year business cycle bottom last year, right in line with the U.S. market and the world in general. And we've had a very nice bull market. South Korea has woke up, and again, a beautiful bull market. The model is saying the bull market should not end till October of this year on into next year, and I prefer next year. Okay, let's move on to the next market, and that would be the China Shanghai Composite Index. And the interesting thing is the 3-year business cycle, or LT1 cycle, kind of got broken up on a bit here. It was supposed to go up and then down, and instead it's gone up, only started to go down, changed its mind, and went up. This has to do with the virus recession, China coming back online, their economy doing better, some of the things they're doing internally, how they manage their stock market and their financial markets. Ultimately, it can still pull back for a late 3-year business cycle bottom, but it should actually move higher into October on into next year for a 3-year business cycle top. My conclusion is the market is either already bottomed for the 3-year or simply won't work. It does not matter. I would focus on the idea of a bull market into next year for China. But because we know there's a chance for a last-minute pullback, it may be that China needs to stall out some more. And I wonder if it hasn't put it in, it does stall out, backs off a little bit, will we actually see a better up move coming out of that low into next year than what we've seen all the way back to, say, 2019? Sometimes you get in these weird patterns, and then when they're resolved, you get actually a stronger move. Okay, so I'm optimistic on China, but the problem is we're going to have to watch out long term for U.S. versus China versus Taiwan versus Hong Kong. All these things can blow up to cause some issues, not only in the Asian markets, but the world and even the U.S. markets, okay? So I really am concerned of some of the relations and some of the things going on, and it can come back to hurt China. So now let's see if we can take a look at what's going on in Japan. And basically what we have is a 3-year business cycle bottom last year, right in line with the U.S. and the rest of the world. Beautiful bull market. And the model's saying here again, it's probably October the earliest for a minor long-term business cycle top, and it can extend higher into next year. And you may recall my long-term forecast for the U.S. stock market is higher into next year, but a setback next year, a correction. It might be as much as 10%. It might be a more drawn-out trading range, and then higher in 23, 24. I think the rest of the world will generally follow that idea. But we can see that some of these foreign markets can actually top out near the end of this year and start that correction for next year, as opposed to staying up into next year right along with the U.S. I do think the China market has been dragging its feet relative to the U.S., but it's still been bullish. It may have to stall out and consolidate a little bit, but I think it still has higher to go. It is possible maybe we've seen the most of the bull run in China, but it's something to continue to keep an eye on. All right, what else do we have? So we got Japan, we got China. Let's move on to, let's touch base on Brazil, because I'm very disappointed with Brazilians and how they're managing their virus recession, some of the other crazy politics going on there. Basically, the model's saying we really ought to have a 3-year business cycle top around October going into early next year. But I'm really surprised at some of the slowdown and struggling here. I'm not surprised, I should say that. When I look at just the price chart, I'm surprised. Then when I look at what's going on in Brazil, I'm not so surprised. I would be concerned if it takes out last month's low. I question whether there's some real opportunities there for most traders. All right, now what we want to look at is maybe Spain's index. Okay, I think Spain's going to be a bit of a struggle for a very long time, but I think it has an opportunity to move higher over time and be kind of in line with the rest of the world. Now, let's see what else we've got here. I didn't see my German. Okay, here's the French index, the CAC. And I think this is looking very well, all right? I think they're making a real bet that they're going to pull through, but Europe still has issues, okay? And I just don't know how positive they're really going to be. But the model forecast is that, and though it could top in October, it's likely not going to top the next year. So I think it's kind of in line with the U.S., all right? So I'm willing to give them a chance. But it is overbought long-term basis. It's been a nice run. We can certainly assume 1 or 2 months at a time where they stab it lower, take some profits. Maybe there'll be some news, maybe not. But I think ultimately it's going to work higher. I think it's probably heading for 6,500 or higher. That's not very good. Most of this analysis for the global side does not include as much fundamental and economic as we would for the U.S. Okay, we're kind of betting on the cyclical pattern more than anything. What are these major players? What do they want to do? Okay, this is the German DAX, new record high, looking well. And the model's kind of saying that, you know what, this thing can stay up into next year. It's not really showing a chance for an October, December top this year. It's saying it should go up into next year, similar to the U.S. Again, it's been a nice run. We have to allow 1 or 2 months setbacks. You can see here we get a little setbacks, but most of the time, what does the DAX do? It spends most of its time going up, similar to the U.S. Market. All right, let's swing back over to, say, India. And I'm bullish India for a few decades at least, unless we get that super cycle bear market and crash, 1929 crash or something. Other than that, I think India is going to do quite well. It has hesitated for a few months here, and it's just consolidating. I don't see anything wrong with that. Yes, it's slowed down. Yes, a violation of any of these monthly lows should concern us a bit. But ultimately, I think India is going higher into next year, right in line with the U.S. Forecast. All right, let's switch over to the global Dow now. And basically, the global Dow is the model forecast is saying higher into next year. Now, that's primarily based on, let's face it, this index is primarily driven by the U.S., okay? But it is giving us a general idea. This is a global bull market. And look how long in the past, 16, 17, how long the global bull market lasted. Then it spent a long time chopping up. We have to be concerned someday we're going to get a sideways move for maybe a year, okay? Or it's going to be a struggle maintaining record highs, things like that. But ultimately, for the moment, I think with all the money printing around the world and specifically in the U.S., I think this market moves higher into next year and then has a correction. That's the global index now. Again, some of these countries can top out earlier than that. All right, now what I'm going to do is I got to go under my sectors. I'm not going to include U.S. sectors. What I'm trying to do is inside my sectors, I have some foreign funds I want you to take a look at. Okay, so this is the Japan ProShares. So it's actually a leveraged fund. It probably means you can make or lose twice of what the underlying index would make. And it's going for what? $48 a share, something like that. And this is for Japan. And we can see it might be a little more sluggish acting than the actual Japan index. But at any rate, well, at the bottom of this chart, I divided it by the S&P 500 2x fund to keep trying to compare apples to oranges at least, or at least apples. And you can see, even though we've had a nice bull run for Japan, really this relative strength indicator is saying it's really just keeping up with the U.S. market. It's neither stronger or weaker, and it had been not as strong, if not even weaker in the past. I don't know what to make of this. Is this indicator too low here? If you look at it, going all back for its history back to 2007, you'd say, my gosh, someday this thing has to pick up, okay? Well, yeah, but when is it? And this is ongoing research. This is something I'm just trying to develop here. Can we use the core modeling technique, the technology, and apply it to ratios, spreads, relative strength indicators to actually time when a market might start outperforming another market? I'm thinking in years down the road here, it's possible Japan's going to do better than US just because of this indicator is so historically low. It's just saying Japan's not rallying as fast as US, or it's rallying about the same pace. I just think there's going to be some kind of reset. Problem is, right today, this research is not conclusive enough to give us a real hands-on model and call a bottom. But it is something to watch out for. That is it possible Japan can do better? This has nothing to do with the economics and fundamentals. So if you like what you just seen and said, wow, I better dig deeper in Japan, yes, you need to look at those fundamentals and economics. Is there something there where it can perform better than the US? Now, this is ProShares fund of the MSCI EAFE indexes, okay, of Europe. All right, so at any rate, here's our relative strength indicator, and look how low it is. It's just saying it's dragging its feet. It's not moving up as fast as the US market. Will someday that mean a wake up for Europe? Well, we don't know for sure. It can spend a long time low and then move up, and then look how long it went down. Maybe something's broken with Europe, but maybe it's going to be decades from now before it speeds up relative to the US. I don't know. And you also have to remember that if the markets went down, if the US market went down, this indicator could move up in the sense that the European market just doesn't move down as fast as US. That's an interesting little twist. So my conclusion is that there could possibly be something in the next few years here where Europe is going to catch up more with the US, if not rally better than the US. So maybe it is worth investing in. And there's definitely some who are gung-ho on Europe, but boy, there's others saying, man, they've got a long ways to go yet to work out some of their issues here. Let's see what else I've got for you. This is another European fund by ProShares, and it's an ultra fund, so it means it makes or lose twice as much as the underlying indicator, and the underlying indicator is a FTSE European index. And the same story, the European market is just not rallied as fast. It's kind of like keeping up with the US is all it's doing, and maybe even a little bit behind. What the reason of this big decline is actually dropping harder, faster than US. All right, so basically what we need is that I think there's an opportunity to break out. I'm kind of thinking if this relative strength indicator goes above January 2021, maybe that's a sign it can do better this year than the US. Something to think about. Okay, so that's all I've got for you for the update for the sectors. Again, this is ongoing research to try to develop something more useful and timely to give us a little bit of diversification of what we're doing in the global and U.S. markets. Past performance is not necessarily indicative of future results. Manage your risk and have a great day. Thank you.